Welcome to the Daily Update. This is being prepared Friday, April 22nd, where we'll look at the action in the market today and then see how things look for Monday, April 25th. And it turned out to be one stinker of a negative day. Now it looks like we're finally developing a trend. We've been in a real sideways type of environment. Well, we broke some support on Friday, and things were just pretty negative across the board. On the positive side, we're back to being even more short-term oversold, and even some of our intermediate term indicators are showing that we're oversold. So that may produce some kind of a bounce. This was more of an across-the-board decline, and another positive thing is that we were below average volume. So that's kind of critical right now. So let's go back and talk about what happened. At the open, we had a negative open. Things just started negative and then just kept going right from there. We quickly took prices down to S1, which was at about 43.47 in the S&P. Then S1 became resistance because we broke down below that, and selling took prices down to S2, which was at 43.01. Then prices actually broke below S2. Now, we didn't get to S3, but still, it was a pretty negative day. There are some buyers that came in that tried to take prices back above S2, but this ultimately was unsuccessful. And we closed almost at the low for the day. We ended up being down 2.77%. So a pretty significant down day. And as I said, volume was slightly below average. So that can be seen as somewhat positive. Our technicals are negative, but we're showing some oversold indications. Inflation and interest rates seem to be the real focus right now. We do have all the different geopolitical concerns, and then earnings are coming out, and sometimes that can add either something positive or negative to the overall environment. And then we're having Fed people coming out and speaking, and depending on what they say, which most of it is being taken as negative right now. There were some positive comments that were made on Friday, but those pretty much went ignored. So the market just decided it wanted to go down on Friday, and that's what it did. So we really just continued on Friday the selling that started on Thursday. The technicals are negative, but we're showing some short-term oversold conditions and some intermediate-term oversold conditions. The S&P is now back in correction territory. We're down more than 10% from the all-time high that we set way back in January. The earnings that did come out really didn't help things all that much. And then another thing that I ran across is that Germany lowered their forecast for their GDP from 3.6 to 2.2. Now, that may not seem like all that big of a deal, but Germany has the strongest and most robust economy in the EU. And they're really a driving force. And a lot of times, what happens in Europe tends to precede what happens in the U.S. Just like sometimes in the U.S., what happens in specifically Japan or in Asia will happen after it happens in the U.S. Not always, but I have some videos on my YouTube channel where I discuss that more in depth, mainly from a historical point. But this can also feed into economics as well. The 10 to 5 yield curve is still inverted. Yesterday, the 30 to 5 went inverted. It went back into more normal ranges for right now. And then I do kind of a little bit pay attention to what I call perma bears. These are people that are always predicting the end of the world, and at least as far as the stock market is concerned, and the end of the world overall. But they're just always negative. No matter what's happening, the next crash is just around the corner. And a couple in particular, I'm not going to give you their names. I will tell you one thing, that a lot of the real negative folks tend to focus on Elliott wave. Now, those of you listening to this, you might be adherents to Elliott wave theory. I used to have some software that I used, and it was great at telling me what I should have already done. I could have just looked at a chart to tell me that. But my problem with Elliott wave theory is, yeah, I look at it, but it's very subjective. One way of interpreting the waves may be completely wrong. And what I've discovered over the years is a lot of people, again, there's always exceptions to this. A lot of people that rely heavily on Elliott wave, they think that fifth wave down, they've been talking about it for 20 plus years now. And it just, as the market keeps going up and up and up, the crash is just around the corner. And eventually they'll be right, okay? And they'll really tout that. And that's why they're euphoric right now, because they're like, see, told you so, told you so. Well, they were saying this back in 2020 and 2021 as we were going up and up and up and up and up. And that's why I listen to them. Sometimes I get a little bit of insight. But overall, for me personally, I talk about Elliott wave in my classes. I want people to know what it is, but I don't rely on it all that heavily. I've seen some people make posts that are actually more positive, but the kind of the leaders out there tend to be pretty negative overall. And I like to be more of a realist. The market does go up, the market does go down, the market does go sideways. And that's the way I choose to look at things. Not that doom and gloom are always around the corner. I think it's a pretty miserable way to live. Anyway, that's my take on that. The economic report that came out, it didn't really have much of an impact. I thought this might really help things. It came out kind of mixed. One part went up, another part went down, and it really didn't do much overall. As far as our trend, we're starting to see a new trend develop, and that trend is negative. Now, I'll get to that chart, and I'll go through that, and I'll show you, this is a little more aggressive way of using the indicator. Some of you may not feel comfortable with that, and I'll talk about that when I get to that point. So our trend, it is negative. You can't really dispute that, but we're still kind of in a trendless environment too, depending on how you use the ADX. And I'll go through that. Our bias, of course, is negative, and our momentum continues to be negative. So let's look at the day's session. First at sentiment, and CNN went back and changed their charts to this new way that I don't really care for that much. Maybe some of you watching this, it might be easier to see. But we're more into the fear category. We're now at 40. And their numbers are all different. It's like they've got different people calculating this at different times during the day. And I hope that's not what's happening. Is this another thing like CNN Plus? Some of you know what I'm talking about. But I like this indicator, and it kind of gives us a big picture look at sentiment overall. But we're more into the fear category, but still fairly neutral. And here's the longer term chart over here. When we really start to take notice is when we get to the real low levels. Well, we're not at that point currently. Then, I'm trying to do some updates to the charts and add more labels. I know that I go through so many charts, and I have hundreds of other ones that I never talk about in these videos. And I know what they are, and I can see the symbols, and I know what it means. But some of you watching this, you're kind of new to technical analysis, or even if you've been doing it for a while, to figure out the way that I do it. It's like, what's he talking about? What indicator is that? What does that say? What index is he looking at? And I'm trying to add more labels to the charts, but it's going to take me a little bit of time. So some of these charts will have nice little labels that I hope help you, where others, that's kind of my weekend project, is to try to do as much of that as I can. But anyway, with the VIX, we saw a real spike up on the line chart. It closed a lot higher, as couldn't be expected. A lot of fear came in. We were going down. And then even on the bar chart, we closed right at the high for the VIX. So there's been a real spike in fear right now. And we're looking for this to possibly top at some point. The idea is when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Well, what's high and what's low? Sometimes we might be at high right now, but it can get a lot higher. So we just have to kind of watch this in conjunction with some other things. Then this is also another chart where I actually plotted an RSI 9 periods on the VIX itself. And it just shows that we're getting up to kind of an extreme reading right now. And if you want to pause this and look at this chart, you can see just other times when the RSI gets pretty high, then it might be considering to buy. So anyway, I'm going to add some more VIX charts going forward from here, because I think we need to look at that a little more in depth. Then there's also another chart called the VIX of the VIX. This is a VIX measuring the movement of the VIX. And it also spiked up, as can be expected. The Ulcer Index, this goes up as we're going down, and it did advance on Friday. And then this is a new chart. I haven't presented this in any of the videos, but some of you may use this indicator. It's the equity, meaning stocks, put-call ratio. Are people buying puts or are they buying calls? And it makes a ratio between the two. I kind of like this indicator, but sometimes I don't find it all that helpful. The reason I'm having it displayed right now is just because we really spiked up. That means a lot of people were in buying puts as we were going down. And sometimes, if you look at other times, when we get pretty high, that can mark a bottom. Now, the fear and greed index that we use, part of that is the put-call ratio. So this is one part of that overall. So I look at this every day, and I may include this more, as well as some other studies with put-call ratios. Some people don't really like it because they understand the logic behind it, but they think, is it really telling me what's going on? That's why I rarely ever use any indicator in isolation, because there's always a part of the story that you might be missing. Then as far as our sectors, all of them were down. Materials got hit the hardest, healthcare, financial, then tech, and everything was down. The one that got hit the least was staples, and they were down 1.57%. So it was just an across the board, and everything got sold. Kind of like during the COVID plunge, it's like they just took anything out and sold it. So it was pretty crazy. But going back to our all-time high, we still have energy that's been performing. It's taken a hit, but it's still doing the best with utilities and staples hanging in there. And then at the other end, we have communications, tech, and discretionary that are showing the most weakness right now. And these are largely growth stocks down here. Where up at the top, the things that are going up, they tend to be value stocks. That's why I do a lot of, right now anyway, I didn't pay attention to growth and value until the beginning of 2022. I mean, I watched it, but I didn't analyze it because we were in a pure growth mode. Well, now things are changing. We're in a different environment. And so now we have to weigh this battle that seems to go back and forth every day. Here's just one of the sectors that I like to look at. It's the tech sector. It was down 2.8% and is showing a lot of weakness. We're below the moving average overall. Then this is the SOX index. This is semiconductors. This is inside the tech sector. It also, after having a couple of good days, it was down 2.22% on Friday. Now let's look at some inflation measures. The CRB was actually down 1.61%. But overall, we've just been going up. And this is where a lot of the inflation things are coming from. Then to measure how's the CRB been doing against the S&P 500, for a long time, the CRB really underperformed. Well, going back into 2021 and into 2022, the CRB index has really been outperforming. And then this is just a flip-flop. This chart just shows how the S&P had really outperformed commodities, but lately, the last year to year and a half, they've been really underperforming commodities. Now, I'm starting to include more Fed charts because we're getting closer to the meeting. It's just a few weeks off now, where right now we're at a 99.6% chance that at the meeting on May 4th, they're going to set interest rates at 0.75% to 1%. That's 50 basis points or 0.5% higher than they are right now. And that's pretty much a certainty at this point. It would take a lot to change that right now. It's of course, anything's possible. There's still 0.4% that might change, but it's not really all that likely. And we can just deal with the probabilities. And then here's the historical chart. And in the weekly video, I'm going to look at the further out meetings as well. But we see the purple line here, where at the beginning of March, nobody was really considering a 0.5 point raise in the interest rate, overnight Fed funds rate, sorry. But this really climbed throughout the month of March and into April. Then as far as our technical alerts, most of them were negative. Somewhere along the line, right at the open, the NASDAQ went above 13 too. But then we pretty much went down. The S&P dropped below 4,300. All of these. The Dow went below 34,000. The dollar set another 2-year high. It had a good day and a good week and has been having a good year so far. And someday there will probably be a death to the dollar, but it doesn't look like it's happening today. Intraday, here we go. This really, you could just take Thursday's chart and there's a little bit of a pause here and then add Friday's chart to it. We just went down right from the very beginning. Selling just took us down below S1. Then S1 became resistance. We went a little bit lower. They tried to bounce things back up. We went down to S2, bounced around there a little bit, even broke below S2. They tried to get us back above S2 without any luck. And then the last 20 minutes or so just saw selling going into the close, and we ended up closing right about at the low for the day. So it's pretty negative overall. You can't deny that. We've come right down to about, or maybe even a little below, a line that's been on this chart for quite a while, which I'm calling intermediate term support. Can that hold? Are we going to break below that? This could be potentially something positive. Now, we might break below that a little bit, but can we eventually get back above this? If we start to fall, then we have S1 down here, which may act as support. So, but again, looking at this chart overall, we've been here. This is where we've been bouncing around for most of 2022. So, and you could have made a case that this might be an inverse head and shoulders bottom. Here's the left shoulder. Here's the head down here. We're forming some kind of a shoulder. Well, it doesn't look as probable now with the decline that we saw on Friday. But things could still recover from here, and this could be some kind of more like a W type of a bounce. But that Friday's action didn't help that cause. You can see that we were just a little bit below average. So to have a really strong down day like we saw, pretty much selling right out of the gate, and then to have it be below average volume, that is a little bit positive. There wasn't a lot of conviction behind that, but we've been seeing a lot of below average volume anyway. Now, we are down 10.94% from the all-time high. So we're now, at least according to how I measure things, we are now in correction territory. We are quite a bit below the 200-day simple moving average right now. Now, let's go through growth and value, where we saw very predictable growth declined, value advanced. And all of these charts are going to show the same thing. Here's some of the labels that I'm talking about. We take the S&P growth index, divide it by the value index, and that gives us a ratio. And it just shows that value is really underperforming, where this shows that, this is showing that growth is underperforming. This next chart shows that value is outperforming currently. And then here's the NASDAQ 100 against the S&P. It actually didn't do quite as bad as the S&P on Friday. Here's the pure growth index, which saw over a 3% decline. Here's the value index, which also declined down about 3%, but it's looking a little better. The chart, see, we're below the moving averages here, where we're coming down to the 50-period moving average here. So it's much healthy, even though I got shot with everything else. Here's another ratio between the two, which just shows how growth has really been underperforming. This is a couple of ETFs, which measure the same thing. It also shows where growth is underperforming. So I'm kind of hitting that same scenario with multiple charts here. As far as our trend, this is what I'm talking about. We are below the 20 in the ADX. Now, for those ADX purists, where you don't consider anything over under 20 as being in a trend, you don't see this as a trend. If you follow the moving average and the ADX itself and you see this cross, you're a little more aggressive and you see this trend developing. So that's why we're a little bit mixed here. Yes, a new trend is forming. This is starting to turn up, but we're still below 20. So some of you may want to wait to implement some kind of trending strategies until we get a little bit higher, until we see a little bit more follow through. If we bounce back up from here, chances are the ADX is still going to go sideways because the red line really shot up and the green line shot down. And if we bounce a little bit, we're going to see this decline a little bit. So be careful how you use that and come to your own conclusion. I do a whole video on how just to use this indicator. I also have a blog where I wrote an article about this. There's multiple ways that you can use the ADX, and you have to come up with your own way of using that if you want to differentiate between trending environments and trendless environments. Okay, our Arun finally came to life. It came to negative life, but it came to life nonetheless, where the red line really shot up. That means that sellers are in full control right now, and buyers are going bye-bye. And we saw a cross right here. Since we saw a cross, that means our oscillator dropped below zero, and it's decidedly negative right now. Then no change on the decision point scorecard. Over here, let's look at some breadth. And again, trying to put some labels on here. This is advanced declines based on price and advanced declines based on volume. What I do is then we draw this out more as I think the lines are a little bit easier to read, where we did see a decline, but we're above the moving average. Based on volume, we saw a decline and we're below the moving average. Then our advanced decline ratio. This takes a 19-period exponential moving average and a 39 exponential moving average and plots them. Well, overall, our AD ratio declined. Then new highs, new lows. We saw a few new highs on Friday, but really more new lows, but not huge, not big. But however, when you combine the two, we are seeing a real decline and we're below the moving average. Our 10-day differential also is declining. We've dropped below the moving average with our accumulation, which is buying, versus distribution, which is selling. So that is more negative also. Short term, we are way below the 20-period moving averages. And our moving average study saw a decline in the 20, 50, and 200 moving averages. We're way below all of the moving averages in our spaghetti tree here. MACD continues to decline. Swinland Trading Oscillator, based on price, decline and is slightly negative. Same thing with volume, declined and slightly negative. McClellan Oscillator, negative, and another down day or two, and we could get into an extreme negative reading. If we bounce from here, we won't. This is likely to turn up a little bit too. Here's some of our oversold indicators. The Stoke RSI, pegged negative. Williams percent R, pegged negative. Force index, all the way down to the Keltner band. They're similar to Bollinger Bands, but to come down this far, this fast, means that we've moved quickly right now, maybe too fast. Then the rate of change, this is just one period. This is Friday back to Thursday. This just shows that on a one-day basis, we really went crazy. And if you look at this, if you look at some of the extreme readings, sometimes that marked some kind of a reversal coming after that. So that's why I wanted to include this. But we're pretty extreme right now. So this also suggests that we're oversold. Intermediate term, way below the 50. The 100, which had acted as nice little resistance on Thursday, is way in the rearview mirror now after Friday. PMO, price momentum oscillator, is declining overall. When we base it on price, we're declining. When we base it on volume, we're also declining. And then some other PMO studies, those that are rising really dropped off and are getting to extreme negative. Those that are generating buy signals is also declining. And those that are even above zero is also declining. The BPI, bullish percent index, saw a real drop, but not necessarily drastic at this point. And then here's a longer term chart. As long as we stay above 50, the BPI is considered more positive, but we are trending down. That's why I plot a moving average on here. But usually that's a technical alert that's generated when we drop below 50, if that ends up happening in the next few days. Here's the moving average rainbows. And first I have the short-term rainbow, and we're well below all of those moving averages. Here's the intermediate term rainbow, also way in the rearview mirror. And then we've even dropped below some of our longer term moving averages. So yeah, it's hard to get really excited. But look at what happened earlier in the year. We dropped below and we're able to bounce back up. Can that happen again this time? Or are things just so negative that everything is now switched over to being bearish? That's what we're trying to solve each day. Stochastic, short-term, extreme negative. Intermediate term, in extreme negative territory. Longer term, we are declining and just crossing below the midpoint. Summation index, declining based on price and volume. And see, I'm going to put little labels on these charts to help figure these things out. All of our momentum oscillators are negative right now and declining. The commodity channel index, or CCI, based on 14 periods, extreme negative. Based on 20 periods, extreme negative. There's another one I haven't included for a while because this one acts kind of crazy sometimes. This is the Chaikin money flow, and it had been declining, but it was still positive. Well, we finally went over negative on Friday. And here's the vortex. Saw an increase in selling, decrease in buying. So negative overall. RSI, based on the 14 period, declining. Based on the 9 period, declining and getting close to extreme negative. Here's the balance of power. It's below the dash line, so that's negative. It also declined, but it's a little harder. This is a newer indicator to me, so I haven't really decided where are the extreme readings with this indicator yet. I need to use it for a little while. And then this is another new one, a variation on the RSI. This is called the Connor RSI. It's getting down to kind of an extreme point. And sometimes when we hit this level, it didn't really mean much. Other times when we did, it can help us out, or at least lead the way sometimes. Then the Fibonacci retracements, we fell down through the 38.2, and now we're even dropping below the 50% retracement. And then here's our itchy and scratchy cloud right here. And I don't mean to be disrespectful. I just don't know how to say the whole name of this. Ichimoku, I think that's it. But we've actually dropped below the cloud right now. Some of you might use this indicator. I'm not a big fan of it. That's why you don't see it very often. But I know some of you do, so I like to include it when I feel it's telling us something. Then the percent B. This is how are we getting outside of the Bollinger Bands down here? That usually signals either an extreme positive or negative reading. We're getting close to an extreme negative reading with the percent B. Trading systems. Elder, based on the S&P 500, is negative. The spiders, the ETF of the S&P, is negative. Our SAR, stop and reverse system, it never did turn back positive with the dots above, so it's also negative. Our different charts, Heiken Ashi. This is a big, thick, black, dark, negative candle, so that's negative. Our Kegi, the red line means we are negative. Renko, it didn't redraw because it's not seeing anything new. It's seeing the other levels that we were at not too long ago and not registering those in the chart. Three-line break, however, does have a dark candle, so that's negative. Equivolume, just two big, heavy red candles here. Point and figure, no change in the signal. It's still a high pole warning, where these X's were the pole. We just added more zeros to make it even a little more negative right now. So the warning hasn't changed. It's just a continuation of the signal that was generated back on April 12th. I think that says here. Long-term chart, we're below the 200-day moving average on both of our scaled charts. And the mega stocks, they were down almost 3% on Friday. The Special K longer-term oscillator for helping us determine trend is declining. Then our longer-term moving average study, 50, declining 150, and 200. All of those are declining. So a lot of real technical damage has been done. Here's the S&P where we just dropped down. The mid caps dropped, but they're still kind of more at the lower end of this range that we've been in, where the small caps dropped a little below the range, but didn't see as much damage, at least looking at the chart. Here's the Dow Jones Composite, down almost 2.5% right now. And again, this takes the Dow, the trannies, and the utilities, combines them into a composite index. Here's Dow Theory, where the Dow did decline, the transports declined, but not as bad. They got shot last week. And utilities, which had been doing very well, also saw a pullback. This was, again, more across the board selling. FANG stocks didn't really get hit as hard as you might think. They were down just under 2%. And ARK wasn't down as much. A lot of the damage has already been done to both the FANG stocks and the ARK Innovation ETF. So could you say this might be a double bottom? Perhaps. And then here's the Dow, where we finally broke down below the pivot. That's negative, and we're below both moving averages. The Elder Impulse system is negative for the diamonds. Small caps broke below S1, so that is also negative. Mid caps down more, closer into the bottom of the range, but even a little bit below that, and is also a little bit more negative, but not as negative. It was still down 2.66%. It just doesn't look as bad on the chart as things do in the S&P. The NASDAQ just got taken out and shot, down 2.5%, dropped below S1. NASDAQ 100, same thing, down 2.65%, below S1. This is the VIX of the NASDAQ 100. They call it the Vixen. And I've kind of updated this chart a little bit, and I didn't put a little label there. But we saw a real spike up in fear on a closing basis, and on a bar basis, we closed right at the high. The Qs are in a negative trend according to the Elder Impulse system. The NYSE, which had been hanging in there and holding up right above the pivot and above some of these moving averages, it finally gave up the ghost on Friday as well. So this just shows more of an across-the-board action. The S&P 100 actually outperformed the rest of the S&P because the S&P 100, this is how it's been doing lately. So it didn't do as bad the last few days. The Wilshire also had been hanging in there. Well, we dropped below the pivot. And then internationally, we're seeing pretty much across-the-board declines right now. And here's our all stocks, which are world stocks, saw a 2.25% decline on Friday. This chart didn't update. I don't know what's going on with this. We're 1 day behind. So this is after Thursday's action. We were down 0.2%. We're probably going to be down about at least that when the Friday chart finally updates. Here's another one that I don't show all that often. It's intermarket analysis going back to the beginning of the year, where oil has been doing the best. It was up a lot more than it is now, but it's still performing quite well. Here is gold going back to I start this at December 31st. So that's where this is coming from. And then the dollar's been hanging in there. The S&P's been having trouble. And this is bond prices, not bond yields. They've been really underperforming so far. Then here's the dollar, which has really been holding up. We actually got above 101 on Friday. And then here's the weekly chart, which we're seeing a corresponding decline in the euro right now. Here's oil. It actually declined on Friday, down to 102. And here's gold. It was down a little bit. Everything just got taken out and shot. The gold ETF dropped below the moving average. And silver declined almost. I'm sorry, this is the long-term view of gold. I always want to jump to silver too quick. Silver was really hit. It was down over 2%. And it just had a golden cross not too long ago and then looked like it was shooting up, and now it's falling back. Here's the longer-term chart of that ETF. Bitcoin even suffered some damage. We dropped down into the high 39s now. As far as bonds, this is just, and you might want to pause this, these are all the different yield curves that I plot. There's only one that's negative right now, and it should be the 10 to the 5. And I'm going to add more labels on here. And this is just that chart in isolation. Just shows that we're negative currently. And then this is looking at the 30-year yield interest rate. And we've broken above the 61.8%, and we're at 2.95%. We got just about up to 3%. So we'll have to see. If interest rates keep going up, watch that 3% level on the 30-year yield. And then this just shows we're seeing a real bunching up again of the different yields across the board. Internationally, we're just seeing rates really spike up. Bonds continue to go down. We broke through this support, and they're showing a lot of weakness based on price. Corporate bonds got hit on Friday. The current yield is up to 3.92%. We're getting close to that 4%. Still half of what inflation is supposed to be, but we're seeing a rise in interest rates overall with the corporate bonds. Junk bonds declined with the stock market, a little over 0.5%. And here the current yield is 6.38%. And then this is a ratio between junk bonds and treasury bonds. Just shows that junk bonds actually underperformed. But overall, the junk bonds have been outperforming regular. It's not hard to beat bond prices these days. Some of our relative studies, here's gold against the S&P. We've been faked out by this before, but it's still holding up. We're above the moving average after having had a golden cross. Here's energy against the S&P, still looking good. Here's energy against tech. So it just shows how energy's been really seeing a lot of love, where tech has been seeing not much love these days. Here's growth, again, which has been suffering already, against bond prices, which are also suffering. And they both went down on Friday. This is tech against the SPY. It's really been underperforming. Here's tech against the 10-year yield. It just shows that tech has been declining as interest rates have been going up. And I have the inverse of that coming up. We've been really watching this as interest rates go up and tech goes down. We got really close to seeing almost a complete inverse relationship. That's starting to wear off a little bit right now. I'm not sure really what to make of that at this point. Are interest rates getting ready to fall back a little bit, or is this just taking a breather for right now? Then here is the 10-year against tech, where the interest rates have really outpaced tech so far. Here's discretionary, things you don't have to have, versus staples, the things you do have to have, and the discretionary is really underperformed. This is the S&P against interest rates, which, not surprising, are underperforming. These are the low volatile stocks. They were down over 2%, but not as much. And they continue to outperform the rest of the S&P right now. And then this is what we're keeping an eye on. This is small caps. Right here is the red line. And then we have the S&P. If we can come back up and bounce up out of this, that might lead the S&P higher. That we're just keeping an eye on that. It worked really well back in the middle of March. We'll have to see, is that going to generate a useful signal this time? And then another thing we're watching is staples. When they top out, sometimes that means a bottom in the market. Well, we just keep spiking higher and higher. So we don't really know right now what's happening there. So what is our outlook for Monday? The technicals, they're negative. Short term and some of our intermediate term indicators are showing oversold indications right now. We're still in a pretty trendless overall range. And I say that using the ADX in a more conservative manner because we're still below 20. The growth and value battle continues. The supply chain issues, they're still there, but they're not at the forefront right now. We don't really have any economic reports coming out Monday. And then all the different geopolitical events, with right now the focus being inflation and interest rates. But any one of these other ones, Fed speak, Russia, Ukraine, something in China, any one of those can become at the forefront at any time, either positive or negative. So I actually have two scenarios going right now because our ADX is in the process, potentially, of switching. Where, scenario number one, that's where we're at. If you're more aggressive with the ADX, and what's going to keep things going down? Interest rates, if they keep going up and these inflation fears just seem to keep growing, then as earnings come out, that sometimes can help things turn more negative. I'm focusing on the negative in this part. And then any Fed comment. As we get closer to the meeting, these guys are like rock stars, and they're followed around. Their every word is dissected and analyzed to try to figure out any kind of hidden meaning going on. And this could spook the markets. And then our technicals, they are negative. And then I'm going to jump down to number 3 because we're still more sideways because the ADX is still below 20. But it's starting to climb and showing a negative trend at this point. And when we're in a sideways environment, we see a real slowdown. Try to think of that after Friday. Slowdown in price movement and pretty choppy environment. Okay, so what could bring scenario number 2 to life? Short-term and some intermediate-term indicators are oversold. That might produce some kind of a bounce. This is still off the table. The positive backdrop after the yield curves reinvert. Well, we have one of them that's inverted right now. And the staples spike. Sometimes when they spike, that can produce a real move in stocks. Well, we don't know if that's spiked yet or not. The technicals, some moving averages somewhere on something might be able to provide support. We've pretty much blown through all the moving averages on the S&P. And some pivot points that are still below where we're at, they may provide some support, or if we do get a bounce, they may provide some resistance. So our conclusion then is that the S&P is negative. Can't deny that. Short term, negative but oversold. Intermediate term, negative and partly oversold. Our oscillators are negative and we're below pretty much all of the important moving averages. And long-term, we're below the 200-day simple moving averages. And if you hear some scratching, that's a cat trying to get my attention. Here's some of the other videos that I make available. So thank you very much. Have a wonderful weekend, and I'll be posting the weekly video just as soon as possible.